morning, everybody, and welcome to the latest and the last instalment of this webinar series for this year. Obviously, you've got myself, Dan Morris from Crystal Specialist Finance, but the three amigos are back together, and look at that grin on Roger's face. So obviously, we've got the tax wizard, which needs no introduction, John McCaffery from Alexander & Co, and we've got the newly appointed, newly transferred, all singing, all dancing, Roger Morris at Tandem Bank, which I'm sure he'll mention many, many times on this webinar. Good morning, gents. How are we doing?
Very well. Good morning.
Morning, Dan, and good morning, everybody. Hope everybody's looking forward to a crystal Christmas this year, Dan.
Absolutely, yeah. The crystal ball says that everybody is, and it's certainly deserved, and the break is certainly deserved. So, yeah, for those of you that have joined and have been following for, I suppose, all these webinars, you know the format. And for those of you that are newcomers, it's always nice to have new people attend. And with these webinars, again, anything's possible, any discussions
Was possible.
Yeah. Any questions, please do ask. It's free format. Yeah, well, yeah. We see where the webinar takes us, really. So as always, it should be informative, it should be interesting, fun-filled, and again, anything you want to know, you've got myself from a master broker packager point of view, you've got John, who is an expert on all things tax, and then you've got Rog, who, I don't know what you're an expert on, to be honest, because last time we didn't need you, did we? But no, we got Rog back, which is great to have three of us back, and the dynamics are good again. So yeah, but I suppose first and foremost, before we jump into the actual webinar and any questions, because we do have a few pre-asked questions, Rog, do you want to tell us what you've been up to since you've I suppose left OSB, had a bit of time off with your ducks, and now you're at Tandem Bank? Do you want to tell us a little bit about what you've been doing, and I suppose what Tandem does, really? Because for a lot of people, when the announcement went out, nobody's aware of Tandem, and it's kind of the best kept secret, really. So do you want to give us a bit of an overview quickly of that, please?
Yeah, Dan, thank you. So when I left OSB, which was a brilliant part of my life, I was fortunate enough to get 9 incredible offers, but I wanted to try and find a proposition that really understood the intermediary, and particularly for next year, which is going to be challenging, what could have an aspiration to keep the intermediary right at the heart of what they do. Because, Dan, we often see lenders launch and then they go direct to the customer and start to cut out the brokers from their income, and it's their clients. So Tandem is a relatively new proposition to the intermediary market. And the best way to describe it is, if you think right in the centre of lending, there's the high street banks that are trying to cut the intermediary out of the client kind of journey, wherever possible, certainly the product transfers. But where Tandem sits is right on the spectrum from both sides. So we can do a remortgage for someone who wants 50 grand on a 75 grand property to somebody who wants a £5 million loan. And it's about dealing with high net worth, and it's dealing right at the other end to hardworking modern families. And we can do a first charge, a second charge, or even a third charge. And what we'll talk about today, Dan, is we've launched an exclusive product with Crystal today, which we can talk about maybe next, so we're not giving too much information at once, because what I think we've created with Crystal is going to be unique for January, and we call it the Moonshot, and the aim of being able to do a remortgage with Crystal from dip to completion in 10 days. 10 days.
No, it's phenomenal. It'll be market changing and market leading, and we'll park that there because there's a couple of questions which will kind of lead on to that. But obviously, you've had the L's working really hard to bring this proposition to life, and you've got lots of other great stuff going on in the background. But yeah, we'll leave that that process and what that looks like there, because it kind of fits in nicely with some of the pre-asked questions. But is there anything else you want to add on that? Or are you quite content just giving that?
All I would say to anyone listening in today, if you've got any questions about the economy or questions you're getting from customers about how to explain interest rates rises or swap rates, or where those challenging customers will come from, ask Dan now, because where Dan is and what Crystal are doing, I don't know of another specialist packager that has the range, depth and skill set that Crystal have. And if you've got one partner that you want on your speed dial and your mobiles next year, it's definitely Dan and the team.
Oh, you're making me blush. But no, it's true. And you know what, whether it's ourselves or another specialist partner like Crystal, I think next year it's going to be more important than ever to have a great team behind you, similar to the likes of John, Rog, myself, or anybody else that's got a particular skill set, because the market is going to get more challenging. As we've said throughout all of these webinars over the past, bloody hell, 2 years now, which is how long the series has been going, there's been different things thrown at us at every single opportunity. And what we have learned over the past 2 years is we're resilient. We are resilient. I think the only thing left to happen now to impact our markets is King Kong and Godzilla to start fighting. I genuinely think that is the only thing that could be thrown at us now, because yeah, we have seen a lot over the past couple of years, but the fact is that we've all pulled together and it's just another day, and we are firefighting. We are that fourth emergency service in terms of what we are doing and how we are helping our clients. And John, how has it been for you over the past 2 months? So I know obviously a lot's changed in our world, but again, there's been significant things that have changed in your world.
I've never known a period in tax where everything has changed so much so quickly. I think we touched on it briefly last time. We briefly had a Liz Truss government, where we briefly, they did exist. Changes in top rates of tax, freeing up the economy, some stamp duty savings, and then all has changed. So apart from stamp duty savings, the stamp duty savings are now back in place, but instead of being a permanent change, they're now on a temporary basis. And following on from that, they've just issued the finance bill, which is, considering the changes that have gone on, it's the shortest finance bill I can remember. It's 14 pages long, which in terms of tax legislation is more of a pamphlet than a piece of legislation. And all it does basically is reaffirm the fact that everybody is getting a reduction in capital gains allowances over the next few years. That the income tax, if you're on 125 now, you're going to be paying at the 45% rate. So I mean, really, really simple changes. What the future holds, who knows? Because I don't know where they're going to go from it. I really, really don't.
You can borrow my crystal ball if you want.
That'd be cool. If you can, let me know. That'd be nice. Get a jump on the competition.
No, that's it. And I think, again, nobody knows what's going to happen. The good news is, from our side of the fence, is that the markets have stabilized, I think is a correct way of saying it. Rog, I think obviously when we last had this webinar 2 months ago, the rates were all over the place. Swaps rates were ridiculous. But it's nice to see that the market has kind of slowed down. And even with the last rate increase, some lenders even put the rates down regardless of that. And as we mentioned last time, for the first time ever, the rates currently aren't linked to the Bank of England base rate. It's purely linked to the swaps market, which again should give a bit of stability regardless what happens with the next MPC meeting. So yeah, but it is an interesting time. It really is an interesting time. And we'll discuss what the outlook for next year looks like. But we've got a few questions that have been pre-asked, so I will just get them up. So Linda Cleves, thank you very much for asking this question. So background stress testing is adversely impacting loans. And I suppose, what can we do on that? And is it still possible to place these sorts of cases, because obviously rates being higher and background stress testing? So Rog, what are your thoughts on that in terms of background stress testing is adversely impacting loans? And I suppose loan amounts that you can get, and even terms as such.
So let me give you some context and let me set the scene what us three are going to do in 2023 to really help the buy-to-let market. So there's three functions that we need to think about. First about is brokers need to have a higher level of knowledge about the structures of ownership and the ultimate outcome, which is a net positive position for a landlord. So you are not qualified to talk about tax, but you need to have an understanding and you need to be able to explain the differences. So one of the things I've been doing during lockdown is writing the syllabus and the questions for advanced CMAP for buy-to-let. And what we can run is some exclusive educational webinars with Crystal to understand what options are available. And then with John to be able to go into the in-depth detail again when it comes to tax advice. But what I would say is the following, Dan, is 62% of buy-to-lets have no debt at all. And it's about sometimes looking at the overall equity position that a customer has and thinks, how can you restructure? So even if you just have one buy-to-let at say 75%, have you got equity in your residential? It could make sense in raising a bit on your resi to reduce your loan on your buy-to-let, because the interest rate, which you can still offset as a basic rate taxpayer, you can apportion so much of the interest borrowing on your resi and so much on your buy-to-let. As long as you evidence, explain on your submissions to your accountant, can maybe get a better average blended interest rate. Or with a lot of landlords, you might have one unencumbered and one mortgaged. So maybe it's a refinance of the unencumbered and a reduction of the debt on the existing. But in most cases, 75% of mortgage buy-to-lets are held in personal names. And I bet, and I'm going to hand this seamlessly over to John, that there are still in joint ownership as far as the revenue is concerned, the vast majority. And it's just apathy. But I do believe that this interest rate rise will stimulate those to get at least tax advice once. Because, John, there will be a lot of people that with a little bit of simple, straightforward tax advice, a trust document set up and Form 17 put into place, you won't be able to maybe change the consequences of the tax return you're doing in January, but long term you can make that buy-to-let more sustainable and affordable. Isn't that right, John?
Absolutely. It's something we've been talking about for years. Putting forward examples about the interest restriction for higher rate taxpayers, and the fact that your tax is based on the gross rents received after expenses, but excluding interest. And we've been banging on for years and years and years about the fact that it wouldn't take much of a change in percentage interest rates to start turning a number of landlords from a profitable position to a non-profitable position because of the tax cost associated with that loss of interest relief. Yes, you're absolutely right. Some simple planning may well work for certain individuals. As you alluded to, transfers between spouses are generally free of capital gains tax. So transfer of a property, and as Roger said, you don't need to do it by a conveyance. You can do it by what's called a deed of trust, which is a legal document transferring beneficial ownership of some, all of the property to your other half. Where the Form 17 comes into play, if there is a joint ownership of a property between spouses, the revenue assume it's 50-50, regardless of the actual ownership, unless you submit a Form 17. So if you're 50-50, you don't need to. If you're 95-5, you absolutely need to get the Form 17 in, because the tax position doesn't change until that Form 17 is submitted. And you need to be able to evidence what you've said in the Form 17. So either a conveyance over or the deed of trust is an absolute requirement in order to do that transfer. And the benefits could be that your other half is a lower rate taxpayer. They're therefore getting taxed at a lower rate than you are, and a substantial saving could be made.
Perfect. Well, no, exactly that. And do you know what, coming back to that point as well, in terms of background stress testing and even stress testing on buy-to-lets anyway, if you can't get the loan amount based on that rental income because of the stress testing, you've still got the option, stepping away from high street and mainstream lenders, to do top slicing and draw on personal income or background income there. And there's a number of lenders there that'll accept that. And going back to your old place, Rog, you've got Precise that'll do it, and another number of lenders certainly on our panel that'll look at that. So again, if it's a case of you're just off the vanilla market or in the vanilla market, then now more than ever, and certainly going into 2023, the specialist lenders are going to come into their own. They really are. Obviously, the high street lenders have started to tighten their belt since 2020, and there's been no release in criterias because there's been no need to be. If you look at SLAs at the moment, lenders are busy enough at the moment to not have to warrant to try and buy in more business. And if you look at Q4 this year, most lenders completed their targets by the end of October. So they've just been floating and coasting until the end of this month. Because let's be honest, even probably yourselves, you're gearing up now for Q1 next year. Q4, well, Q4 is obviously done, but no one's been interested in lending realistically since October. So I think come January, we'll probably see a change in rates, but we're also going to see a change in market, which...
Dan, let me just put a bit of context in there. I actually think it's going to be more dramatic than that. When you normally would agree, a lender should really agree budgets for 2023 by July of this year. You then deploy your criterion strategy and the rates in the beginning of September, certainly by the end of September, if you want to have a successful first quarter, because we know how long it takes the existing lenders to complete purchases and remortgages. What I would say though, Dan, is because of the uncertainty in the funding markets, because of literally the buy-to-let remortgage and purchase market seems to have stopped because of the news that rates will drop. And we look now at the available housing stock in the market. I think lenders are going to be coming back in January, Dan, going, we're going to fail to hit completely our first quarter target. And they're really going to have to do something, reduce margins, push the boundaries. So I think by the end of January, brokers are going to see an incredible range of opportunities available. Because for the first year that I can remember, lenders are going to be behind the curve right across the board. And it's either the race to the bottom or it's a reduction in margin. But the next year is going to be a very tough year for lenders' growth patterns. That's for sure, Dan. And the power for the first time ever will come into Crystal because you're going to be getting rates and people are going to be coming to you saying, how can we tap into your distribution and what can we do? I know we will at Tandem. We're going to be coming to you going, what can we do to help? But the argument being is it takes an average remortgage 4 months. Why does it take so long to literally change from one lender to the next? So I think next year is going to be quite exciting year, but a tough year.
Yeah, no, I agree. And we'll look forward to 2023 in a second. But I think it all comes down to the SLAs and just the infrastructure in place in these lenders, because we've seen over the past couple of months, and I think probably everybody on this webinar will agree, and even coming from Precise over to Tandem, SLAs just aren't good enough at the moment, and the infrastructure or the team numbers just aren't there to support the business levels. So lenders are still going to be behind the curveball until they get these SLAs under control, because if you start reducing rates to become more competitive, reduce your margins, which is what people should and could be doing, then you're just going to get inundated, aren't you? So it's finding that balance. And there almost needs to be a group WhatsApp with all these CEOs of these lenders saying, look, let's reduce our rates on the same day, but that's never going to happen. So it's just finding that balance and, again, finding the speed, which for a lot of people, similar to the offering that you guys have got, inquiry to completion in days, not months, it's just going to be market leading. Because if we look to 2023, which scarily is what, 2 weeks away, which is just phenomenal.
Wow.
Thinking about it, really, really is. Where is the market going to change to? What changes are we going to see? What appetite changes? What different movements are we going to see by clients? Is the purchase market going to dry up? Is the stock going to continue to dry up? Are new builds going to slow down? Where is the market going to go to? Now, me personally, I get your views. I think it's starting to be a cold winter now. Certainly, if you look outside, it's not been above zero for the past couple of days, but I think the frost is going to start to bite. I think beginning of this month and coming into this month, people will have been fed up with the cost of living crisis. They'll have thought, right, what we'll do is we'll have a great Christmas. We'll spoil the kids. We'll max the credit cards out. We'll put the heat into 24 degrees rather than 18 degrees. We'll buy the biggest turkey ever. And you know what? We'll bury our heads in the sand. We'll not pay the credit card and we'll worry about it next year. And I can almost guarantee you that will be a fair percentage of clients that will be doing that because they've had it hard for the past few months. They want to hide away for 2 weeks' time, see the kids' faces, fill the bellies, and then worry about it in January. But I promise you, when January comes, the credit card bills lands, the default letters come in, people have their head in the hands thinking, right, Christ, what do we do? How can we get out of this situation? Go up the first charge lenders, be it any of the mainstream lenders, ask for a further advance, know the income's not there. So where does the market go? The market goes right into your sweet spot, for example. Second charges come February next year is going to be a huge part of people's business, and there's going to be a huge opportunity there. And I can almost guarantee that out of all the attendees on this webinar now, there'll probably be 10% of people that are actively involved in second charge mortgages because it's not a solution they look to provide. And I think that is going to be a huge part of where the business is going to come from next year and where the food's going to be put on their tables and our tables. And it's not something historically that we've done maybe back to 2021, but we've seen where the market trends are going and we've geared up massively for this. Now, what are your thoughts on the market in terms of where it's going to go and I suppose where people are going to get the next meal from next year, because it is going to be not to scare, but it is going to be a tough year in comparison to what we've been used to, isn't it?
Yeah, Dan, I think you articulated that so well. Just on service levels, when I joined Tandem, their second charge division, their SLAs were 1 day. On average, they would issue the offer the same day. And the time from decision in principle to the loan being paid out, including weekends, so not working days, is 23 days. So just over 3 weeks from decision to pay out. And they'll do second and third charges. So third charges become often, and you go, third charge, why would you do a third charge? Maybe you've been doing some works at home and the cost of building materials gone through the roof, or you're in shared ownership. So shared ownership, a second charge is in effect is a third charge because it's the second charge is taken by the housing association. But when we look at what you said there, which is the mainstream, which is remortgages, Dan, we're going to launch with Crystal in January what I call the Moonshot Challenge. So I have gone through the processing at Tandem, and I believe you can do a remortgage case, let's say debt consolidation. So you've got your credit cards, you've had the heating expense, you've got the bills, you come due in January, and you've got more going out than coming in. You ring the broker, and the broker does very detailed, comprehensive advice, because debt consolidation is something that needs to be considered and not taken lightly. But regardless of how long that advice process takes, once the decision to debt consolidate, the customer wants that value, that reduction in expenditure now. They don't want to wait 3 months, 4 months. Now, the next bit is being in reality. I can remember, Dan, when you were young, if I had to pay out £450 for a val fee, we haven't got it. We had no headroom on a credit card. So it's easy saying, well, just do a remortgage. But one of the biggest reasons that stops people doing it is they have no upfront fees. So what we'll do with Crystal is, subject to the advice being given and the decision to do a remortgage, the Crystal Moonshot prize is the following. We will not charge an upfront valuation fee. 75% of our cases, Dan, have been able to use AVMs. If a physical valuation is needed, we'll pay for it. So Crystal and Tandem will cover that upfront fee, okay? It's only if the property is more than 700 grand, which in the majority of cases isn't. Crystal will then, through AVMs, do an AVM at dip stage. So the broker sends a dip in, we will, or you will, check out whether or not that property meets the valuation requirements. 75% of cases it will. So you've got the property value. Next, you do the affordability check, taking into effect that unsecured debt will be repaid. So you've got that. So then when the application comes in, particularly on tier 0 and tier 1, Dan, all we need is 1 month's payslip. You will electronically send that through to us, and 95% of cases the offer will be issued that day. The broker and Crystal, during the dip stage, will request a redemption statement from the lender. What next will happen, which is unique in the marketplace for Crystal, is we or you will instruct and pay for a courier to turn up to the client's house where the couple is, for example, and witness the mortgage deed, which is sent out by pure law and is electronically emailed to the courier. Come to your house, you'd sign, collect, and it would go back. Now, we offer free in-house legals with this joint venture with Crystal. Now, in-house legals isn't some nonsense remortgage factory working for 100 quid. It's literally our specialist team of our employed staff, Dan. So let's say if someone's got 6 pieces of unsecured credit, where lawyers have to satisfy that debt because for the right purposes of affordability and ensuring the customer's not in a problem, our teams will pay off that debt on completion. No charges made, no fees for electronic transfers. There's no cost for the courier service because you're paying for it, and there is no cost for the legal service. So an unencumbered property, we could complete the next day. The only thing that takes us a bit of time is that redemption statement, but that predominantly is all we need because they own the house. You don't need to go through all the searches because the customer owns the house. They just want to transfer the debt. And if there's a broker fee being charged, Dan, we'll add it to the loan and we'll pay it on day completion, as with the lender fee, but we won't charge any interest on those 2 fees whatsoever. So I actually think it's possible. Our current record is 18 days because we've only been doing it in trial with a couple of master brokers, but I truly believe there's a broker out in Crystal that can complete a remortgage in 10 days. And that's not working days, Dan, that's actual days.
No, that's phenomenal. It's a good bit of insight. And I think what could be beneficial after we've done this webinar is sending out some information on that, just giving people an overview of what we've discussed and what you said there, because again, there's some great USPs. And as you've mentioned, and as the saying goes, time is money. It really is. It really is.
Yeah.
You don't have that 4 month period because the credit score, for example, and the credit issues could be massively impaired in comparison to when the application started, because as you say, they just simply can't afford to potentially go on as they have been. So they need it now, not in 4 months' time. So yeah, and that could be the straw that breaks the camel's back. So yeah, no, it's a good bit of insight, that, and it's a great USP. And again, as long as your SLAs stay good, then there should be no reason why you wouldn't get a shed load of business. There really, really isn't. And John, coming over to you in your world, what do you see the market moving to, or any significant changes next year in terms of
the tax rules are going to stay, or look like staying, pretty static. If your market changes to one whereby you're looking at second and third charges, they are, and I don't know in your case, but they are generally more expensive in terms of the interest rate that attaches to them. And so it becomes more important than ever that your structures are looked at, because if you find yourself in that financial difficulty and you've got your structure incorrect, then you're paying a higher interest cost and getting less tax relief for it. So you may want to start sharing ownership. You may want to start looking at company structures. You should absolutely get your structure right, otherwise you're just making your problem worse.
Okay. Yeah, perfect. And there's a question that's came in, which I suppose we get all the time. It's a bit of a statement as well, really. So we're seeing a significant shift in parents gifting or selling, whatever you want to class it as, properties that are investment properties to their children. And you know what's coming next? For example, market value is £200,000. but they're wanting to give the property to them at a value of £100,000 to repay the mortgage. So it's their mortgage is paid off, and the new clients' children can then raise finance against it. Is it possible to sell a property under market value to direct family members? And if so, what are the implications of that?
Okay, I mean, I've been doing tax 25 years now, and it amazes me that this still keeps coming up. Legally, yes, you can. You can sell your property for £100,000 to your kids, right? From a tax point of view, the person disposing of the property, right, will pay tax based on the market value, regardless, absolutely regardless of the consideration they put down. You are connected for tax purposes to your kids, and therefore there's a rule that replaces actual consideration with market value consideration. So not the most brilliant piece of planning in the world, because they may get 100 grand and then they're going to pay a load of tax based on the 250 grand position. Now, from a stamp duty point of view, stamp duty is payable on actual consideration. Okay, so if the kids are paying 100 grand and they've already got another property, they're paying 3% stamp duty. If they haven't got another property and this is their first time purchase, then depending on a bunch of things, if it's going to be used as their main residence, they might get some full stamp duty relief, but it's below the 250 mark. So they shouldn't pay any stamp duty on that. But for capital gains point of view, no, you're absolutely paying tax based on the 250.
Okay. And how would HMRC, this is a question as well, how would HMRC find out that it is below market value?
Sorry.
I said that's easy because their new system, John, every property that's sold, every property that's bought, it runs an algorithm behind. It's the most sophisticated system. This is my understanding, John. So when you sell a property, it will sense check if that is significantly below, which then triggers a further investigation. That will be my understanding.
The HMRC have got a computer system called Connect. It's one of the few good things HMRC, from their point of view, have done recently. It sources information from 30 different sources relating to individuals. So, and one of them is the land registry. So they can look at the land registry, see the transaction, compare it to transactions of similar, in a similar area. Technically also, and it's like, how will they find out? I mean, I can't advise on tax evasion. You are meant to return it on your tax return because it's self-assessment, so you're meant to self-assess. You're also meant to do a CGT return. And if after all that they don't get you, right, and you've deliberately avoided the tax, right? So if you've not fully disclosed, they've got 6 years to look at it. And if you've deliberately not disclosed, they can go back 20 years.
Okay, perfect. And if anyone on this, I suppose, webinar thinks, I suppose, differently, if there's any tax advisors on, because sometimes you do get them on, let's flip it over to the lender's side of things. Now, Rog, what complications could you see this causing if the clients wanted to, say, raise £100,000, so the full purchase price or the full transferred value against the market value? Would a lender allow this?
Yeah, so the first thing a lender would need to do is to make sure that the legal work had insolvency cover for the parents, because the first thing is, are they disposing of assets prior to some form of bankruptcy and some sort of issues? Because therefore, regardless of John's and the revenue's point of tax, is whether or not our security is reliable, because it might not be theirs to dispose of because there's other things going on in the background. And second, when it comes to that equity position, there is a lot of lenders that will accept that parents would gift, and there is lenders that will accept. What is the difference between an equity gift and a cash gift? In reality, if you've got a proper valuer going out there and valuing the property, the value would have to go out and give its true open market value. And if there's 100 grand of equity there, where is the risk to the lender? It's just literally to make sure that what's going on is a declared transaction. And what we would do is when we are triggering that purchase, we would trigger that purchase through as 200 grand. And that purchase would go through as 200 grand. Stamp duty would be paid on that property at 200 grand. And that stamp duty return would go, and that would will connect directly with the revenue that John sells off a property for 100 grand and Dan buys it at 200. So there will be a connect between the two, which is why, and again, as a lender, we must always say, you've got to be open, honest and transparent, but ignoring the fact that there will be that 28% tax liability that the parents would pay, which has to be factored in, because you'd argue, if I'm going to give it to you for 100 to pay off the mortgage, really I should be giving it to you for 130 to cover the tax liability. And a lot of parents just forget that, don't realise that, but it is a consequence further down the line. But in simple parts, yes, lenders will consider that, who have that policy and criteria.
Right, no, perfect. That's it. And it's true. And I just wanted to clarify that point as always, because now more than ever, I personally am seeing it as well, where even the clients have been given this tax advice and it's just incorrect. And the only person that I trust, that I know, that gives tax advice is John, and I would genuinely trust him. Not so much with my life, but with my finances life. So again, if you are looking to link up with a tax advisor and someone who's actually good, or should we say even great at what they do, then John's your guy, because very reputable firm. But again, he's, as you've seen on these webinars, he's just so knowledgeable. It's phenomenal. And a lot of it goes over my head and even Roger's head. So yeah, do link up with someone like John, if not John. The next question that's came in, again, similar to Linda's previous question, is it's from Kieran Boyle. So thank you for this. So buy-to-lets for older clients seem to be getting declined more. Now, I wouldn't say we've seen such a, I suppose, an increase in this, but I understand that there has been an increase in this, and a lot of it comes back to, if you're putting it to a lender, again, like Precise, I'm sorry to keep mentioning Roger, it must hurt.
No, it doesn't.
I'm joking. Who do top slicing, if they're using that income, which only goes to say 70, 75, then obviously it doesn't go up the full term of the mortgage if the mortgage term is going up to 85 years old. So ultimately, the reason why some of them will be getting declined, because if you're relying on that background income for the stress, then the income isn't there. That's why either they're getting declined because of the term, or the term's getting dramatically reduced in line with when that income is going to stop. But for anything like that, even the issues of the background stress testing, we do have options available. So what I would say, and I suppose a business plug for me, is if you are getting cases declined, come and speak to us, because we've always got options. Sometimes, granted, they're not the cheapest options in the world from an interest rate point of view. But again, as the more specialist the lender is, the higher the interest rate is going to be. But again, there's always solutions there for pretty much every single client in every single situation. So ultimately, again, fast forwarding into 2023, if it's cases that you are getting declined, or clients that historically you may not have wanted to help, not so much from a point of view of you wanting to help, but being able to, or dealing in a particular sector which you're not comfortable with, you can simply pass them off across to Crystal and refer these sorts of clients to us, and we can help you find that solution for that client, get them in that property, get them that debt consolidation, refinance that commercial loan, and also increase your income as well, and create new opportunities for you, which next year's webinars are going to be all about. Obviously the tax positions, tax implications, but most importantly, creating new opportunities from a lender point of view, and also looking at tax opportunities where you can look to diversify your income more, but help more clients in a more diversified range, really. So hopefully that answers your question, Kieran.
Dan, can I just pick up on that? Again, it's about Precise was brilliant about allowing an application for an older person where their age is under 71, so it can be 17 year 11 months and do a 35-year term. So there's a big part of the market would say even Kent Reliance wouldn't go beyond the age of 85, but Precise would, which is why it's important to have variations in policy. One of the biggest reasons that older people are not able to get what they need isn't ICR, it's the length of term. So why would, I mean, L&G, for example, if they have a pension, they don't call that pension in when you get to 85 because you need that for income. A buy-to-let, so 1.5 million people over the age of 60 have a buy-to-let in this country, and it's their pension. 1.5 million of the 4.5 million landlords. So it's a big percentage, and they need that to sustain their lifestyle. So the first bit is lenders should not be prescriptive about the age of application, the age of completion. They should let it go through. That's the first point. And when Tandem launches its mainstream buy-to-let offering, we won't have that minimum age. And Tandem Bespoke, it currently will allow anyone to apply regardless of the age. But the second point, Dan, is when you're using top slicing, the bit again, which is why most buy-to-let lenders, that the people who create the policy don't understand, is John now is using top slicing, and John is a barrister on 200 grand a year. And the reason for using top slicing, part of the reason is top slicing, because John's income, which you're using to support the loan, is the reason that you're having to do it is because of the ICR, because he's a top rate taxpayer. But when John gets to 75, if he didn't have a pension, he'd become a basic rate taxpayer, which means the ICR could drop and the requirement for top slicing is not needed. So are lenders looking at when they stop work to recalculate what that ICR needs to be? And the answer is no, because most people are going, I didn't even understand what you said. Because the ICR at application will be different when there's a drop in income. So it's about looking all the way through. But I would say most people, and then there could be, when you do retire, Dan, you take a lump sum from your pension. And as long as you say that that's going to then repay your debt and recalculate what that debt would be, you therefore don't need top slicing. So you've got to have a lender that really understands that journey of income and tax that that customer will go on. John, there is some thought in that, isn't there, in the sense of how your tax bands can change according to your income status?
Oh, absolutely. Yeah. I mean, you're taxed on the income you earn in a particular tax year. The other things kicking into that is that those people have got inheritance tax considerations to kick into. Investment property is not great from an inheritance tax point of view. Debt against your property reduces your inheritance tax exposure. You're talking about pensions there. Pensions are excellent from an inheritance tax point of view. If you've got sufficient funds and don't need to use your pension, you can pass that on to your kids inheritance tax free. It's essentially a trust. And it's just, as I constantly remind people, it's a question of looking at your individual circumstances and making sure you get your efficiencies in there where you can.
Okay, perfect. No, I appreciate that again. Thank you for that insight. And John, have you seen it all in the past couple of months? I suppose just quickly, of any or many landlords offloading their portfolios?
Not specifically. There's a lot of landlords are pretty much attached to their portfolios. I have seen a bit of an increase in corporations. So people are very much looking to cash in on the fact that you can get full interest relief in companies over personally.
Yeah, no, I agree.
We've seen not a lot of sales.
No. I mean, I've seen, certainly around me, there's more and more portfolios coming up for sale. But I've certainly seen that uplift as well of people looking to incorporate, and more and more purchases coming through Crystal via limited companies. Terry Wayman, he's said other tax advisors are available. They absolutely are. As mentioned, similar to ourselves, it's just about linking up with someone like Crystal, someone like John or John. I only mentioned John purely because, like I say, I trust him. I've worked with him for a while now. and we do trust them implicitly. But absolutely, there's loads of tax advisors out there available that are suitably qualified and brilliant at what they do. So yes, you're absolutely right, Terry. Is there any further live questions before we start wrapping this up for the year? Again, it's just been a standard session, but next year it's going to be more and more, I suppose, not so much educational, which it will be, but it's going to be about creating opportunities, as mentioned. So what I would say is, after this webinar, if you do have any ideas, anything that you'd like Crystal to cover, or the three of us to cover in these next webinars, then please do mention to us, because we take all feedback on board. So yeah, but Rog, do you have anything you want to add in terms of the outlook for next year, or give an overview of how this year's been, just to kind of finish up nicely for the year?
Yeah, I think this year, particularly for younger advisors, has been a baptism of fire. If you've been advising in this industry for the last 15 years, your wordplay with customers, particularly when product transfers coming up, is, "Hi Dan, I can get you a product transfer. I can reduce your outgoing by 100 quid. Do you want it? Yes or no? Yes, done." When it comes to purchases, you're looking at rates as 1% fixed for 5 years. And there was a bit of walking into what was going to be an obvious disaster. The government, the Bank of England, kept telling everyone that interest rates were either brought down because of the last crisis, because of the economy, then it was COVID. Interest rates had to go up. The Bank of England have always said they've got to be at least 2%. And what you've got now is to really have that knowledge and confidence to talk about swap rates, gilt rates. The Bank of England base rate is no longer connected. And it's about realizing more than ever, you need to stay in front of your customers constantly. Once a month, send them a newsletter, letting them know that you are the trusted source, and send that on a Sunday morning, Dan. It's the highest click-through rate. But secondly, January, you want to be communicating with every one of your customers to check in to say, do you need help? And if they need to reduce their outgoings, their next call needs to be to Crystal. And it's about, this is my customer, this is the situation, what do you think we can do? Is it a remortgage? Is it a second charge? Is it a third charge? And it could be a 3 or a 4-step journey over the next 12 months to get them into a stable position. And it's, if you don't understand second charges, we'll do a webinar and an education on that, or what a third charge is. But I think more than ever, my 2 top tips: stay close to your customers and stay even closer to Crystal.
Thank you very much for that. And yeah, no, I agree. I think if we look at 2021 was the year of the purchase of the stamp duty holiday. People wanted bigger houses. People were breaking up and going their separate ways. And that's what the market looked like in 21. If we flip forward to 2022, it was very much, we're going to develop our properties, we're going to take a further advance, remortgage, or even again looking to purchase. But the purchase market changed probably beginning of half 2, where actually bridging finance became more apparent than ever and more of a useful tool than ever. With SLAs being so slow and so high, more and more people were turning to bridging, because actually, again, if you look at it, when I mentioned previously around seconds, time is money. It's not so much time is money, it's just time was what was most valuable, certainly for these older clients, which had spent the past, 1-2 years stuck inside on their own, away from the children, the grandchildren, 200 miles away. They want to move to that dream bungalow they've found round the corner from the children, and ultimately didn't want to wait for their property to sell. So bridging finance became, I suppose, one of the most, used products in the marketplace, and it's still one of the most used products that we're seeing at the moment, because again, if you want something done quickly, and certainly done in the inside 6 to 8 weeks, realistically, the only product available to you is going to be the bridging finance. As we flip forward to 2023, I think it's going to be the year of the remortgage, which, if you look every single month next year, there's 100,000 fixed rate mortgages that are due to expire, which clients will currently be panicking, looking to secure rate transfers, rate switches, which again, from an advisor point of view, you're working a hell of a lot harder for your money because you could be transferring them to a different rate, a new rate becomes available, you do the transfer again, a better rate becomes available. So you're not just doing it once, you're doing it maybe 3, 4, 5, 6 times, which again, advisors that I'm speaking to are doing. And I think, again, next year, as mentioned, second charges are going to be huge. So if it's not an area that you're active in, then I suggest that you start looking to give advice in this particular area, or linking up with a partner like ourselves that can take these clients on a referral basis and still pay you a large percentage of the proc and let us do the work and give the advice. So whether it's ourselves or one of the other brilliant packages in the marketplace, it's worth building that relationship. And I think next year as well is going to be the year of just diversifying your income. I really, really do. If you're just fishing in the vanilla residential and buy-to-let market, I think we need to start collectively looking at commercial opportunities. You've done a residential mortgage for a business owner, right? Okay, you've trusted me with the biggest transaction in your personal life. Let's look at your business opportunities, the commercial opportunities. Okay, looking around development finance, probably 5% of the UK market of mortgage brokers that are active speak around development finance, 10 to 15% look at bridging finance. It's worth looking to diversify your income. And again, we're there to help you. We're there to educate you on these sorts of sessions. Obviously, we live and breathe it on a daily basis. Now, I'm absolutely not saying pass it through us, give it to us. We'd love it, but we're here to educate the marketplace. But I do think people are going to have to start diversifying where they get their income from and what sort of sectors they are actively active in. And again, that comes down to what John's involved in from a tax point of view. So it's not so much just looking at that particular transaction and that particular sale, it's the add-ons. A lot of people still don't do the presentation on protection because you know what, the client doesn't need it, the client doesn't want it. It's the GI stuff as well, looking at finding them opportunities for the GI, but then plugging in all the other ancillary things like the tax. So again, it's just creating more opportunities from that one opportunity that's in front of you. And I think that's what everyone needs to start focusing on next year, to diversify income and then hopefully grow the businesses. And John, that was a bit of a waffle from me, but again, all relevant. What's your final parting words for this session in terms of next year and this year and what it's looked like?
The tax advice basically follows what is going on in the marketplace. I don't know what's coming up in the spring statement. I imagine there'll be changes. I imagine following that, we're likely to have a change in government at some point in the not too distant future, which will then drive further changes. And as I've alluded to several times, look at your structures, absolutely look at your structures, because if you haven't got them right, you'll have a significant tax leakage.
Perfect. No, thank you for that. And one last question, which just came in from Terry, so thank you very much. First of all, when are the educational webinars for buy-to-let? Now, Crystal run an array of webinars on buy-to-let with different providers. However, we can run one ourselves. I'm more than happy to run one, the three of us, just discussing buy-to-lets and just, I suppose, anything around those really. But John, this question, the next part of the question comes to you. So can you explain briefly the advantages of an LLP over a limited company, please?
An LLP is only advantage if it works for you. So it's very much circumstance specific, right? If you are a higher rate taxpayer, generally from a tax point of view, an LLP doesn't give you an advantage. LLP is a limited liability partnership, and the clue's in the name really, it gives you limited liability, but it doesn't alter your tax position. So if your basic rate taxpayers coming together, you can move your properties into a limited liability partnership. There's no stamp duty unless you're transferring the properties to somebody else, another partner. And you will have limited liability without losing the benefits of being a basic rate taxpayer. If you are a higher rate taxpayer, you're still going to get the interest restriction if you're in a limited liability partnership. You may, at that point, want to start thinking about a limited liability company. You can, if you've been in a limited liability partnership for a period of time, and I'm loath to go further down this because people then jump on the bandwagon of I'll put it into a partnership for 3 months and then I'll square it into a company. If you've been in a limited liability partnership for at least 3 years, you can transfer properties from a limited liability partnership to a limited company without a stamp duty charge, but you should take advice because it's not as simple as that.
Yeah, no, it never is, and we'll not go any further into that because
No.
we could be here all day. And again, if it's something that people want to hear about, want to discuss, we can build a webinar around implications, pros and cons, benefits, advantages, disadvantages of every ownership structure movement. So yeah, but I think look, we'll look to sign out now. I just want to say a number of thank yous from me really and from Crystal. So first and foremost for these two on the webinars with me, it wouldn't be possible. Certainly without John, because he is the show pony, he is the fountain of knowledge. Rog just likes to come on and just be Rog. But no, thank you very much, gents, for coming on and making
You're
this
welcome.
second series of these webinars a huge success. I'm sure next year we'll be back bigger and better than ever. I want to just say a special thank you as well for the unsung hero working in the background, which is Dave Taylor, our head of marketing, because ultimately, if you didn't put all of this together, didn't orchestrate it and set it up, then we would literally just be sat looking at each other on our own, probably having technical difficulties with our microphones and cameras. So Dave, honestly, thank you very much for setting this all up and just running these and being the unsung hero in the background. It really does mean a lot. Most importantly for you guys, the attendees, I'm guessing you do find it beneficial that you do return time and time again, and new people do come and go. But thank you very much for supporting, because again, without everybody coming on, it'd just be me looking at Roger and John thinking, well, this is fun. So thank you very much for your input, your questions, your attendance, and your involvement throughout this series. And like I say, next year we will be back bigger and better than ever with more educational sessions. So anything that you do want us to discuss, any topics you want us to cover, then please do email myself, get in touch with our marketing team. And I'd just like to take this opportunity to wish everybody a great festive break. If you're switching off like ours, like we are, brilliant. It's probably the only time the world does switch off. If you're not, if you're working through like a trooper, then I take my hat off to you. But whatever you're doing, enjoy the festive break. We'll all come back recharged, ready for 2023, which is just phenomenal. Guys, do you want to say some closing words and we'll wrap this up?
John, go on.
No, just happy Christmas, everyone. Hope you have a great time.
Happy Christmas, everyone. Health and happiness for 2023.
That's it. And from the Northeast, it's over and out. Have a great day, guys. Speak to you next year. Bye-bye.